There is a pattern forming in the silver market right now that most everyday investors are completely missing. And the strange part? The people who are noticing it the most aren't talking about it publicly. They're just quietly acting on it. If you've been watching silver and wondering why the price hasn't exploded yet, even though so many signals seem to be pointing in that direction, this video is going to answer that question in a way that might genuinely surprise you. Welcome to Silver Signal, the channel where we break down precious metals markets, smart money behavior, and the kind of analysis that goes deeper than the usual surface-level headlines. If you're new here, hit that subscribe button right now, because the content we cover on this channel is exactly the kind of thing financial media tends to overlook. And if you've been here before, you already know, we don't do hype, we do research. So let's get into it. Because what's happening behind the scenes in the silver market right now is one of the more fascinating stories in the financial world, and almost nobody in the retail investing community is paying attention to it. Here's the thing about smart money. It doesn't announce itself. It doesn't show up on Twitter or post YouTube thumbnails. It moves quietly, strategically, and usually long before the rest of the market figures out what's happening. And by the time the average retail investor reads the headline, the accumulation phase is often already complete. That's not a conspiracy. That's just how markets have always worked throughout history. Think back to what happened in the gold market in the mid-2000s. Central banks and large institutional funds were gradually increasing their gold positions for years before retail investors started flooding in around 2008 and 2009. By the time mainstream financial media was calling gold the greatest investment of the decade, the early smart money had already been sitting in their positions for years. The retail wave didn't create the move, it amplified it. Now here's the part that should make you pay attention. We're starting to see some strikingly similar behavior patterns developing in silver. And unlike gold, which gets all the headlines, all the TV segments, and all the mainstream coverage, silver is still operating largely under the radar. And that's exactly where smart money likes to work. So what are we actually seeing? Let's walk through the data and the patterns that are worth understanding. First, look at the physical silver market. Industrial demand for silver has been growing steadily across multiple sectors. Solar panels, electric vehicles, semiconductors, medical technology, and advanced electronics all require significant quantities of silver. This isn't speculative. These are hard supply and demand dynamics driven by real-world industrial expansion. The Silver Institute and various commodities research groups have been documenting this trend for years. Silver isn't just a monetary metal anymore. It has become an industrial critical material. Now here's where it gets interesting. When you have growing industrial demand on one side and a supply chain that has some well-documented constraints on the other, mining output, refining capacity, recycling limitations, you create the conditions for a market that is quietly tightening. And sophisticated investors who follow commodities closely understand how to read those kinds of structural shifts long before they show up in price. But the industrial story is only half of it. The other half is the monetary angle, and this is where smart money behavior becomes especially worth watching. For decades, silver has functioned as both an industrial material and a monetary asset, a dual role that makes it behave differently from most other commodities. When inflation concerns rise, when confidence in fiat currency weakens, when geopolitical uncertainty increases, silver historically begins to attract a different kind of buyer. Not the industrial buyer placing supply contracts, but the capital preservation buyer who is looking for a hard asset to hold value through turbulent times. We've seen significant macro shifts in recent years. Inflationary environments, rising debt levels across major economies, shifting central bank policies, and growing discussions around de-dollarization in various parts of the world. Each of these factors historically has acted as a tailwind for precious metals. And while gold tends to be the first beneficiary of that kind of capital rotation, silver has a history of following, and when silver moves in those environments, it tends to move fast. Here's a market observation that veteran precious metals analysts often point to. Silver has a habit of underperforming gold for extended periods, and then suddenly compressing that underperformance gap in a short window of time. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically been a tool that sophisticated investors watch carefully. When that ratio climbs to historically elevated levels, it has sometimes signaled that silver is undervalued relative to gold. Patient, informed buyers have historically used those windows as accumulation opportunities. And this is precisely the kind of signal that smart money tends to act on, while retail investors are still focused elsewhere, on tech stocks, on crypto, on whatever the current narrative cycle is pushing. Silver isn't exciting right now in the mainstream conversation. It doesn't have a viral moment, it doesn't have celebrity endorsers, and it doesn't show up in trending financial hashtags. And for long-term, strategic capital, that's often exactly the environment they prefer. Now, let's talk about something that doesn't get nearly enough coverage: the behavior of silver in futures markets and the positioning data that becomes publicly available through regulatory filings. Commodity futures position reports, which are released by financial regulators, show the positioning of different categories of market participants: commercial traders, large speculators, and smaller traders. Analysts who follow these reports carefully have noted periods where commercial positioning in silver, which tends to be associated with entities that have deep market knowledge and hedging expertise, has shown patterns that historically have preceded price movements. This isn't a guaranteed predictive tool. Markets are complex, and no single indicator tells the whole story. But when you layer positioning data on top of industrial demand trends, monetary tailwinds, and the historical behavior of the gold-to-silver ratio, a picture starts to emerge. And that picture suggests that informed, sophisticated capital has been paying careful attention to silver in a way that isn't showing up in mainstream financial coverage. There's also something worth understanding about the psychology of retail investors in general. The retail market tends to be reactive rather than proactive. Most individual investors don't start paying attention to an asset class until it's already moved significantly and made news. That's not a criticism, it's just human behavior, driven by how financial media operates and how attention works. We pay attention to what's already happening, not to what might be about to happen. Smart money, by contrast, tends to be positioning itself based on forward-looking analysis, supply and demand projections, macro trend analysis, historical cycle comparisons, and deep market research. They're not waiting for the headline, they're trying to be positioned before the headline exists. This dynamic creates windows, and those windows don't stay open forever. When a narrative finally breaks through into mainstream awareness, it usually happens quickly. And at that point, the early positions are already established. The accumulation phase is over. What begins next is the distribution phase, where early buyers sell into the retail demand wave that they anticipated. Understanding this cycle doesn't mean you can time markets perfectly. Nobody can. But it does suggest that paying attention to where smart money appears to be directing its focus, even before the mainstream narrative forms, is a valuable part of any serious investor's research process. So the question becomes, and this is what I want to leave you thinking about, if the structural case for silver is as compelling as the data suggests, and if sophisticated investors do appear to be paying closer attention to it than retail investors are right now, what does that historical pattern tell us about where we might be in this cycle? That's not a question I can answer for you definitively, and anyone who claims they can is overstepping what market analysis can honestly deliver. But it is a question worth asking. And it's a question that the smartest participants in this market appear to already be sitting with, and acting on, quietly, in ways that most people haven't noticed yet. If this kind of deep dive analysis is what you've been looking for, if you want to go beyond the surface level financial content and actually understand what's driving markets beneath the headline, drop a comment below and tell me what aspect of the silver market you want us to dig into next. I read every comment, and your questions genuinely shape what this channel covers. And if you found this video valuable, please share it with someone who follows precious metals or is trying to understand how smart money thinks and operates. The goal of this channel is to bring that level of analysis to an audience that deserves access to it. Silver has been one of the most underappreciated and misunderstood assets in modern financial markets. But the people who understand its history, its dual role, and its market dynamics have consistently found it to be worth paying attention to. And right now, the signal is getting harder to ignore, even if most people haven't looked up long enough to see it yet.